Utilizing your own banking system will allow you to enhance the returns on all your investments. It will create passive income, preserve your wealth, and give you access to tax-free cash flow. Now today, let's look at the difference between paying cash for a real estate investment versus using a policy loan from a properly structured life insurance policy. Now on the left, I put up some numbers. We've got a $100,000 purchase. We're going to hold the property for 30 years. Rent's going to be $1,000 a month. And I'm keeping the numbers very simple for our example today. Now the first thing we're going to look at is the market value. What will the $100,000 home grow to in equity over the 30-year time period? Well, I've got a future value calculator that shows us a current value of $100,000. And we're going to assume a very conservative 4% appreciation a year over the 30-year time frame. And that gives us a future value of the home of $324,340. Now the other thing we want to look at is cash flow. In this example, cash flow is $1,000 a month for 30 years, and that gives us a total cash flow of $360,000. So this is our cash purchase. We've got $324,340 in market value plus $360,000 in cash flow. And we've got to subtract out the $100,000 cash that we used to purchase the home. So we've got a total of $584,340. Not too shabby. But let's make the same comparison now using a life insurance loan from a properly structured life insurance policy. By using this strategy, you earn interest on every dollar you put into the system for the rest of your life. There's no lost opportunity cost. You redirect all the payments back to a pool of money that you own and control. There are a lot of benefits you get from this strategy other than what I'm about to show you. Now we know the market value is going to stay the same regardless of where the loan comes from. But cash flow is where things change a little bit. If you take a policy loan, that means you're going to have a payment that goes back to the life insurance company to pay off the loan. So that's going to reduce the $360,000 cash flow. And the way we look at that is with the loan payment. So we have a $100,000 loan. The insurance company charges a 5% interest rate, and that gives us a monthly payment of $535. We have to take our $1,000 a month and subtract the $535. That gives us a monthly cash flow of $465. So instead of $1,000 a month cash flow for 30 years, we now have $465 a month cash flow for 30 years. And that gives us a total of $167,400 in cash flow. Now you may look at this and say, yep, policy loan doesn't work because now I've got less than $584,000. But here's where the policy loan comes into play and becomes very valuable. The $100,000 you took out as a policy loan is still growing inside the policy. So even though you have a policy loan for $100,000, the full $100,000 cash value is still earning interest and growing inside the policy. So now we come back to the calculator. What does that $100,000 look like in the future? We're going to show $100,000 earning a conservative 4% return. And over the 30-year time period, that money grows to $324,340. And the reason I'm using a 4% return is because a properly structured life insurance policy will give you a 4 to 6% a year return. Now we have the market value of $324,340 plus the cash value of $167,400 minus the $100,000 cash. And now we add the $324,000 growth from the $100,000 loan. And that gives us a total of $715,080. By using a policy loan for one real estate deal, you see there's more cash at the end of the investment. This is the power of a whole life insurance policy. But wait, there's one more thing we want to consider. This looks fantastic, and we see that the policy loan is better. But let's take it one step further. Now, where do most people put that $1,000 a month cash flow? A bank account, and it's earning nothing, or they spend it. But let's give it the benefit of the doubt and say you're saving this money inside of a bank account, and that money is going to grow a very, very tiny bit. Now, what about this? What if you are a disciplined investor and an honest banker, and you put that difference in cash flow between the $1,000 a month and the payment, and you put it back into your own banking system? When we do the math, look at what happens. We take the $465 a month, and we earn a conservative 4% interest rate over the 360 months. That's an additional $323,809. Now, to be fair, we have to take out the cash flow number of $167,000. But instead, we put in $323,809. Now, let's do the math. That gives us a total of $872,489. Now, this is the option we have. We can choose to reinvest the $465 back into our policy. This is just one example of how to increase your wealth. There are many other opportunities out there. This strategy can be coordinated with retirement planning, other businesses, business succession planning, and other purchases you make throughout your lifetime.